You'll need to have two things in front of you as we go through this short video. Part 4 of the unit notes and the articulation handout. On the screen you see the version of really short, simple financial statements that are on that articulation handout. I'll reference these to highlight some of the things that are in the outline, but I'm not going to go over every detail because I know you've seen that information in other places. Read the outline very carefully if you're looking for a more in-depth review. The financial statement that is highlighted here on the screen is a balance sheet or a statement of financial position. The balance sheet is basically a detailed representation of what we would call the accounting equation. I've got the accounting equation there in the light purple box. The accounting equation is the basis for the double entry bookkeeping system. We define assets as all of the resources of a business, and we define liabilities and equity as different types of claims against those resources. All of the resources of a business can be claimed by somebody, either creditors or owners. Liabilities are the claims of the creditors. Equity is the claims of the owners. As a result, total assets will always equal total liabilities and equity just because of the way we define these terms for accounting purposes. And if you look at the balance sheet, you can see we've got 2 years represented here, and in each year, total assets of this little business is equal to the grand total of all of the liabilities and the stockholders' equity accounts. Take a minute and look closer at the shareholders' equity section down here of the balance sheet. Corporations will always have two different types of equity. They'll have a variety of types of contributed capital accounts, common stock, preferred stock. There can be a lot of different titles. Here I'm referring to them generically as contributed capital. Contributed capital represents the capital that the owners of the corporation have put in themselves, generally in exchange for the issuance of stock. The other source of owner's equity comes from the operations of the business doing what it was formed to do. That type of equity is called retained earnings. The name is very descriptive of what that account represents. That account represents all of the earnings, all of the profits of the company over its entire life accumulated to date, less the amount of those profits that's been distributed to the owners in the form of dividends. So it's all of the earnings of the business that have been retained inside the business as opposed to being shared back out with the shareholders. In this case, we can see that at the end of the most recent year, retained earnings was $1,800. As a result, we know that this little business has been profitable over its life so far. It's earned $1,800 more than it's paid out to shareholders in the form of dividends. We can also see that retained earnings has increased from $1,600 at the end of the prior year to $1,800 at the end of the current year. This number, $41,800 at the end of year 2, is total shareholders' equity. It's the sum of these two different types of equity. It is also often referred to as the book value of the company because it's assets minus liabilities. It's the leftover book value of the company. What's really important to realize from the beginning here is that the book value of the company is the accounting valuation of assets minus the accounting valuation of liabilities. This generally will not represent what this company is actually worth. It generally has very little connection to the fair market value of the business and the business's stock. Generally, book values are much less than fair value because accounting valuations are very conservative. In addition, a company can have lots of very valuable assets that don't show up on a balance sheet at all because they just don't meet our accounting definition of an asset. Let's think about a simple example. Assume you're looking at the balance sheet of a corporation that's been in existence for a long time, maybe 50 years. You might see listed on that balance sheet a land account, and let's say the land account has $300,000 in it. That $300,000 more than likely represents the historical cost of land that company purchased sometime in the past. Let's assume, in fact, that our company purchased the land 40 years ago at that $300,000. When you're looking at the balance sheet today, you still see the land on the balance sheet at historical cost. However, in reality, it's very possible that that very same land is now worth $4 million. Because of the way we measure land on a balance sheet for accounting purposes, the company would continue to report the land at the $300,000 it paid for it, even though it may be worth $4 million today. That's one example of how balance sheet valuations can be conservative. As we move forward in the course, you'll see that there's a mix of valuation rules for a balance sheet. Many things are recorded and maintained at historical cost, but there are some other items where we use some sort of representation of a more current fair value. Let's change gears now and take a look at another of our basic financial statements, the income statement, also often called statement of operations. There's probably more names for income statements than there are for balance sheets, actually. In my simple representation here, we're looking at the income statement just for 1 year, just for one accounting period. In real-life financial statements, you'd see at least 3 years worth of income statements side by side. Just as I said, the basic format of a balance sheet was the same as the accounting equation, assets equals liabilities plus equity. You can see a fairly basic format for an income statement here as well. Revenues minus expenses equals net income. When expenses are more than revenues, you'll end up with a net loss. Unlike assets and liabilities, revenues and expenses aren't things, they're processes. Revenues are the inflow of assets in exchange for providing goods and services. Expenses are the consumption or use of resources in the process of earning that revenue. Let's contrast the income statement and the balance sheet for just a moment. There's a really key difference here. If you're looking at this income statement and all you had was just the bottom part, revenues of $6,800 minus $6,000. Let's say this is the income statement for my little tax preparation business. So I hand you this income statement and you say, oh look, the business made $800 of net income. The next question that you would ask me is, but what am I looking at? Are you giving me net income for a month, for a year, for a week? An income statement shows you revenues minus expenses for a specific period of time. If you're looking at financial statements that are prepared annually, such as these, then that income statement represents a year. So that means this business's profit was $800 for an entire year. A balance sheet, on the other hand, shows everything that a business had as of a particular moment in time. So cash is cash. At midnight on December 31st of year 2, this business had $45,800 in cash. So that's cumulative up to this point in its life. So they're very different in how the timing is represented. The next two statements we'll look at, the statement of retained earnings and the statement of cash flows, are similar to an income statement. They're both showing results of some type of operations during a particular accounting period. The balance sheet is the one that's different than the rest. We'll move to the statement of cash flows next. First of all, remember that because we're using the accrual method of accounting, profits are not the same as cash flows. They wouldn't be anyway, because you can have positive cash flows from borrowing from a bank, but under the accrual method in particular, you can see wide discrepancies between net income and cash flows. As a result, shareholders are very interested in having this financial statement, the statement of cash flows. The statement of cash flows also has a fairly simple structure. The $45,800 was cash at the end of year 2. The $32,200 is cash at the beginning of year 2 or the end of year 1. The whole purpose of a statement of cash flows is to describe for investors what happened during the year to cause cash to increase by that $13,600. So this $13,600 increase in cash gets broken down into 3 different types of cash flows: operating cash flows, investing cash flows, and financing cash flows. So the statement of cash flows basically provides details for lenders or investors about where that change in cash came from, what generated that total change in cash. For now, for me, you should be able to recognize whether any particular cash flow is an operating activity, investing activity, or financing activity. Look at the definitions in your textbook and on the sheet of notes. Finally, let's take a look at this last statement. This is a statement of retained earnings. Generally, when you look at corporations' published reports, you'll be looking at something called a statement of shareholders' equity. A statement of shareholders' equity reconciles every single account that's listed in the equity section of the balance sheet. We'll generally just prepare a statement of retained earnings because that's where the most interesting things happen. A statement of retained earnings has the purpose of explaining how retained earnings changed from the balance at the beginning of the year or the end of the prior year to the balance at the end of the current year. So our statement of retained earnings is explaining to a lender, investor, or other user why retained earnings went from $1,600 to $1,800. Well, what kinds of things change retained earnings? Think of what the definition of retained earnings is. Retained earnings holds all of the profits of a company reduced by the amount of those profits that's been paid out in the form of dividends. So retained earnings changes by the amount of each year's income and the amount of each year's dividends. So if you take retained earnings at the beginning of an accounting period and you add net income, comes straight from the income statement, and you subtract dividends, the amount of the net income that got distributed to owners during the year, you will end up with the ending balance in retained earnings. So this little statement really is the glue to the financial statements. It really ties together the income statement and the balance sheet.